Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He has over 25 years experience working in the hedge fund industry, and he has been blogging and documenting credit bubbles and global macroeconomic news and events since before the 1999 and 2000 technology bubble burst with his blog, the famous and first global macro blog, the Credit Bubble Bulletin. He also manages the tactical short portfolio for McIlvaney Wealth Management. Doug Nolan, thank you for joining me again.
Hi, Jason. Nice to be back with you today. It's been 21 or 20, I guess 23. This is year 23 with my blog now. So, and you said it's famous. Others might say it's infamous, but anyway.
Well, you've been warning people. I mean, you were early with the technology bubble, right? So you were warning people though, and we had a lot of similar type of day trading behavior with altcoins. I mean, history repeats itself, right?
Sure, absolutely.
So my first question is, what do you think are the biggest risks to the global economy right now?
Yeah, there's a number of them. And that's what makes this such a high risk environment. Let's start with China. From my analytical framework, China is one of the great credit bubbles in history. That went on for years and years, and that bubble is now bursting. And we get some headlines, some stories, some focus on the real estate market. Basically, they've had an apartment bubble there that's one for the history books, and sentiment's now changing. The major developers are in trouble, and I think this is just the first inning of what will be a very long, difficult financial and economic reckoning for China. But when I think about the global environment, and let's go back a bit, because I started in 1999. I was saying, we've changed finance here. We've, no more of the old bank focused credit system. We now have this new age market backed, market securities backed system. I thought it was a very unstable system. I thought the bubble had burst in 2000, wrote as much. In 2002, I had to change, reverse course, and I started warning about the mortgage finance bubble in 2002 because it was clear at that point that the Fed was stimulating, and you already had these strong inflationary biases in housing, mortgage finance, and if that continued, that was going to be a bubble. It went longer than I thought it could go. To greater extremes. I thought the bubble burst again in 2008, had to reverse course in 2009. I think it was March or April of 2009, I started warning about what I feared could be an unfolding, what I called the global government finance bubble. And it did inflate much greater than I would have imagined. But what makes things so dangerous today is it really is a global bubble. China's one aspect of it, the emerging markets. There's basically synchronized bubbles, across the globe. This is not just credit. This is also, asset speculative bubbles, stocks, bonds, real estate. So from my analytical framework, and I've been following, the macroeconomy very closely now for over 30 years. This has been the worst case scenario from my standpoint. So I view the world right now at the very early stages of synchronized bursting bubbles. And I hope things are not as dire as I fear they are.
So you talked about prior bubbles. What seems to me, and I started in 2007 reading investment books, starting news, started looking at your blog, I think 2009, 2010, some friends told me about it. The rules just change so often now. There's backdoor bailouts, there's covert bailouts. If a foreign central bank or a large European investment bank gets in trouble, the Federal Reserve secretly gives out currency swap lines. There's all this stuff going on behind the scenes. Are the people in power, these governments and central banks, are they going to continue to be able to change the rules, do covert bailouts, QE, move the goalposts, do all these things endlessly, or is there a limit?
Well, Jason, little bubble theory here. And I often say that if you have a bubble financed by junk bonds, it could be rather spectacular. We saw that with the telecom bubble in the dot-com bubble in the late 90s. It can be spectacular, but it generally doesn't last that long before people just say, wait a minute, that's enough junk for me. I don't want any more junk. And then, the bubble kind of ends. It ends before it becomes deeply systemic. What I've been warning about now for over I guess it's been 13 years, at least on this phase of the bubble, is this part of the bubble, it's gone to the heart of money and credit. It's gone to central bank credit. It's gone to sovereign debt, the perceived safest amount, the safest type of money and credit out there. And that makes this a very, very dangerous bubble because it's been able to go on for so long. And I fear that when you have a bubble in money, in government debt, you're really setting up for a crisis of confidence in finance more generally. Right now, things are being held together. There's still, we'll call it the Fed put. There's the Beijing put. There's the ECB put. There's this perception that policymakers still have things under control globally. So we continue to have rampant credit growth, speculative excess, et cetera. I think at the end of the day, they're not going to be able to hold this together. And in this unfolding global crisis that I see, not only will it be a crisis of confidence in the markets, in finance more generally, but I fear also in policymaking. I remember back in 1998, the mantra in the markets were, the West will never allow Russia to collapse. And that was part of the reason there was all the leverage in Russian debt instruments and all of that. And then, 2002, even through part of 2008, the mantra was, Washington will never allow a housing bust. And it's exactly that framework, that psychology that allows all the excesses to basically ensure an inevitable bust. And right now, the view still is that global policymakers have this under control. And I call it the holy crap moment, where everyone's confident that they have it under control, and all of a sudden, oh my God, maybe they don't have it under control. And that's when it turns very serious. And I don't know how we avoid that at this point, unfortunately.
Well, I think there are limits. Look at the Bank of Japan. They were doing Japanification. They were monetizing government bonds. They were buying Japanese government bonds. And there were days where Japanese government bonds really didn't even trade because they were all bought. The Japanese government or Japanese pension funds were buying them all. But now over the last 6 months, Japan is even having problems. The Bank of Japan's having problems. Their currency against the dollar has had a lot of problems for a while now. So I think there are limits. What Japanification went on for over 30 years. So I think there are limits at some point.
Right. In Japan, there's a lot of focus on debt markets in Europe, Italian, Greek debt markets, and there's focus on China. Here in the US, a lot of focus on technology and crypto and some of these other bubbles. But Japan, they have a historic bubble of their own. They've issued enormous amounts of government debt, enormous amounts. And right now, the Bank of Japan is putting a ceiling on their bond yields. They're basically pegging their bond yields at 25 basis points. Well, okay, that's fine, but is that sustainable in a world of surging inflation and rising bond yields? I don't think it is. So that's one more market dislocation that's just kind of lurking out there that I fear, that dislocation will come at the same time some of these other dislocations come. And again, the markets will fear that the central bankers no longer can control these speculative and market dynamics.
Well, the Bank of Japan, in theory, they can continue yield curve control or Japanification. They can try to cap bond yields, but then their currency, their foreign exchange rate is going to take a big hit, right? And then that's going to cause a lot of domestic inflation with currency devaluation and their exchange rate problems because of how much Japan has to import for energy and other raw materials.
Exactly. And that's an excellent point, Jason. And that's why I think it's unsustainable. Because they're pegging their yields at 25 basis points. Meanwhile, the currency's down 20% for the year, and inflation is going to make their real rates so negative that at some point the Bank of Japan has to back away from both stimulus and their yield curve peg, and that process will not go smoothly.
But haven't they publicly said that they want more inflation and that they want to continue to devalue the currency? But there's going to be limits to that because the Japanese people, they're going to start voting out the people in power. So the people in power who are okaying, approving, or enacting these policies are going to get voted out of office. And because the average citizen, they're not growing their income. They don't want really bad stagflation and tax increases.
Exactly. And we've already seen that. There was a big pushback when the head of the Bank of Japan, Kuroda, said that he welcomed the higher inflation, and he had to backtrack because the public was not happy about those comments whatsoever. They've been battling what they call deflation for a while. I don't really call it deflation. They've been wanting inflation to increase, and I think it's one of those, be careful what you wish for, because once that gains a foothold in your system, it's very hard to control it. And it certainly looks like it's gaining a foothold in Japan after all these years.
So there was a really interesting story a couple weeks ago. Most people haven't talked about it. New Zealand Central Bank, the Reserve Bank of New Zealand, citing large losses on their quantitative easing, debt monetization, government bond buying program the last 2 years, handed the New Zealand government a large bill to cover the losses on the QE bond buying program because the bonds had lost so much money, the currency had been devalued. Do you think that many central banks besides the US have hit a limit with their monetary inflation and quantitative easing bond buying programs?
I don't think they've hit a limit. And, I believe, unfortunately, the Fed's balance sheet only gets a lot bigger down the road. It was a few years back, or this was before the pandemic, I said during the next crisis, I expected the Fed's balance sheet to inflate to 10 trillion. And why did I expect it to go to 10 trillion? Because there's so much leverage speculation in the world, and that's hedge funds leveraging, all the leverage in derivatives, and all the speculation on leverage, that when you get into these de-risking, deleveraging, these crises where there's the leveraged players have to liquidate because they're losing money, there's only one buyer out there, and that's the central bank. So my assumption was the next crisis, the Fed's balance sheet would have to expand aggressively. Where I was wrong in my analysis is, they didn't quite get to 10 trillion. They got to 9 trillion. But where I was wrong is I thought it would get to 10 trillion during a period of de-risking, deleveraging. Well, instead, the Fed, we started to see some de-risking, deleveraging in 2020, in March of 2020. But the Fed's QE was so aggressive that all they did was re-energize leverage speculation. So here we are today, the Fed's balance sheet's at 9 trillion, but I think the amount of leverage speculation in the world is much larger. So inevitably, when we have a de-risking, deleveraging, and the Fed has to come and provide liquidity again, maybe their balance sheet goes to 15 trillion. So I don't think they can just wind down QE. I do think at some point, though, the bond market's going to say, wait a minute, enough is enough. And I think also it's problematic because the next round of QE, when it comes during a crisis backdrop, I think inflation is going to be a real issue already. So the Fed's going to be adding liquidity in an environment of problematic inflation, only making the inflation situation worse. And at some point, I think the bond market protests. And maybe when the bond market protests, the Fed finally will say, wait a minute, the more QE we do, the higher bond yields go, so we can't do QE anymore. But we haven't got to that point yet. So there's nothing disciplining the Fed, really. And the Royal Bank of New Zealand, they've always been a disciplined central bank, one of the premier central banks in the world, and they're at least admitting that there's a hole from QE, and that's the hole is the difference between what they purchased securities at and what the market value is today. But the Fed has the same hole, but they don't mark to market, so it's not an issue for them, or it's at least to this point not an issue for most central banks in the world.
Yeah, and they also don't have the US dollar as a world reserve currency. Reserve Bank of New Zealand, I think they went from owning in 2019, if I remember correctly, approximately 9% of the government bonds outstanding. I think over the last 2 years, I think they got up to about 40%. So I think that's their limit, but they don't have the dollar as a world reserve currency. So I think for the non-G7 countries, not Japan, not the United States, there are limits to how much debt monetization without taking enormous currency hits and domestic inflation and stagflation.
Absolutely. And that's the point I should have made there. So, and I mentioned the Reserve Bank of New Zealand, that's one of the premier central banks. People respect that central bank. There are a lot of central banks in the world that don't have that respect, and especially in the emerging markets. In the emerging markets in particular this year, we've seen currency weakness, we've seen bond market weakness, equity weakness, we've seen capital flight, hot money outflows, de-risking, deleveraging. This is very problematic for these economies. And if those central banks do QE, that just creates more liquidity that then wants to get right out of those economies. So it's that liquidity will immediately be sold and exchanged into dollars, euros, yen, etc., putting more weakness on those currencies. So I think, it's very important that this year the marketplace is at least disciplining the emerging market central banks.
And we're recording this interview on Wednesday, August 17th, 2022. The dollar index is at 106.67. Do you think if the Fed continues to hike interest rates, if the dollar against other currencies continues to remain strong or rallies even more, is that going to cause some of the emerging market debt collapses, the other problems that you as working in hedge funds, covering global macro for decades, experienced in the past, like the tequila crisis, the Asian tiger crisis, those types of crises? Are we going to see a repeat of that again if the dollar continues to rally and the Fed continues to hike rates?
Right, Jason. And if you go back, it's just a few weeks ago, not many weeks ago, you have this very problematic situation where you have de-risking, deleveraging globally. So that's an unwind of leverage in higher yielding instruments, so-called carry trades and such. And a lot of this is in derivatives where, the speculators are borrowing in cheap dollars or cheap yen. You can, borrow for free or negative in euros, and taking that money, that finance, in investing in higher yielding instruments. It could be Brazil, or if you want more yield, Egypt, Nigeria, wherever, right? And that works fine until it doesn't. And we've been in a situation this year where once that unwind starts, it sets off a lot of negative dynamics where the hot money wants out, the emerging market debt markets falter, their currency falters. Then their central banks, they have to liquidate treasuries and some of their other holdings to support their own currencies. So when they're liquidating their treasuries, that just leads to more illiquidity and higher yields in our treasury market. And that's a very problematic scenario that, again, we saw this a few weeks ago, not many weeks ago. And it manifested also into surging yields in the periphery of Europe. Italy in particular, Greece, Portugal, Spain. And that sets off a very problematic dynamic in the European banking system because European banks are levered in those instruments. So once this de-risking, deleveraging starts, there's a lot of negative things that start to unfold and liquidity evaporates quickly. What we've seen over the past 2-3 weeks, we have a short squeeze going on right now in equities, we've had a short squeeze in periphery European bonds, in treasuries, and in U.S. fixed income generally, in emerging markets. We've certainly seen a squeeze in derivative markets. There had been enormous amounts of hedging, especially in the CDS market, the credit default swap market. And we've seen an unwind of a lot of these bearish hedges, a lot of these speculations. So when you have this unwind, the markets have the appearance of being highly liquid. That's just the way it works. And then, people jump on board and want to play the the rally, and they think the worst is behind us, and all of a sudden the markets look great. Well, the crisis kind of lurks in the waiting there because the markets, if the markets reverse lower and we get into de-risking, leveraging again, quickly we're going to see a liquidity back in the markets globally. At the same time, the Fed's going to be stepping up its QT, its quantitative tightening. It's going to be shrinking its balance sheet more aggressively starting next month. So a lot of analysts on Wall Street are kind of signaling all is clear here. I think this is just kind of the calm before the storm. Maybe the storm is this fall, but in no way do I think markets are sound, healthy at this point.
Oh, I agree. But didn't the Fed also set up a permanent foreign repo facility? So there's a domestic repo facility, a permanent one, and then there's also a permanent foreign repo facility where these foreign central banks, they can post their treasuries as collateral without dumping them, and then they could get access to dollars. So I think that was set up in the last 18, 20 months to prevent these different central banks from all rapidly dumping their treasuries.
Yeah, there's all types of mechanisms. And I think a lot of these mechanisms, they kind of spur this faith in central bankers. Central bankers have it all under control and everything's fine. And it's that mindset that ensures that the amount of excess gets even bigger. So I always feel like the central banks, whatever program they set up to backstop the markets, well, then the markets will just have greater excess to kind of outgrow the previous backstops. So
I agree.
I don't think these swaps are going to resolve things if we get into a serious crisis.
Oh, I totally agree. These portfolio managers at investment banks, these hedge funds, these family offices are all looking for cheap sources of capital to put on those leverage trades. Like you're talking about leverage carry trades, leverage derivatives trades, leverage bond trades. I mean, the risk parity trade during the repo crisis 2019, it blew up. Everyone who was over leveraged on the risk parity trade and the basis trade, all these hedge funds blew up.
Yeah, and this is a unique environment because the Fed over a couple of years, inflated its balance sheet by $5 trillion. So there's a lot of liquidity kind of lurking out there. So my view is that we've had the initial phase of de-risking, deleveraging. And part of the reason it didn't spiral completely out of control is because of this liquidity excess, the residual from QE. But I think over time, that residual won't be as impactful. And as I said, we have QT coming. So I think each one of these bouts of de-risking, deleveraging will be more problematic from a liquidity standpoint and from a confidence standpoint going forward.
I am very skeptical about quantitative tightening and what the Fed says is their official balance sheet. I mean, I've spoken with DC insiders who speak with Federal Reserve Bank employees in DC off the record who go to parties and stuff and speak to them. And there's trillions of dollars off balance sheet. The Fed is hiding it already. I mean, there's a source on Twitter, Occupy the Feds, and they're tracking the Fed data each week. And there's Fed asset purchases that don't match their balance sheet every single week. So tens of billions of dollars. And the Fed insiders like Danielle DiMartino Booth and the former New York Fed trader who's tweeting all the time, they're saying that the Fed is just reinvesting interest payments. The numbers just don't match. I think the math is fuzzy, and I think the Fed is just moving a lot of these asset purchases still off balance sheet now, while the official balance sheet number will be reduced with quantitative tightening. Off balance sheet is where the fireworks are. I think they're moving a lot, maybe tens of billions per week off balance sheet.
There's a lot at stake now. We're talking about an unprecedented global crisis potential, especially if China implodes. So I just assume that there'll be all kinds of things done globally to try to hold this together. So nothing would surprise me. There was a economic, we had the productivity report was a week or two ago, and it showed the worst productivity in the U.S. in a long time. And that speaks to the structural damage that's been done to the real economy. If you have this kind of credit excess, this kind of speculative excess, this kind of malinvestment, this kind of misallocation of resources, at the end of the day, it's your real economy that's going to be your problem. And the Fed and global central bankers, they can print more money. That's not going to resolve anything. That's not going to improve the structure of the real economy. So central bankers can do whatever they think they need to do to try to keep the system from, imploding, I guess. But at the end of the day, it's going to be about an adjustment to this economic structure, having an economy that doesn't need trillions of new credit every year to sustain itself. We have thousands and thousands of uneconomic enterprises that have sprung up over recent years. Why? Because money's been free. It doesn't matter if you make profits, right? The money's been going to any kind of crazy idea. Well, at the end of the day, we're going to have one heck of an adjustment period, because you got to clean that out of the economy. You got to have a healthy, sound economy, and it's going to take years. And the longer we delay starting that process, the worse it's going to be. So I don't really focus too much on some of these things the Fed might be doing behind the scenes. I'm sure I don't know. It's not going to make anything better. That's for sure.
Oh, I totally agree. But I mean, it allows the Wall Street banks to continue making profits. They buy assets for 100 cents on the dollar. So if you're working on Wall Street or a hedge fund manager, you're getting a bailout, your profits are privatized, your losses are socialized, you're getting your bonuses, you're getting promoted at work. Maybe if your leveraged bond trade didn't blow up the firm.
Right.
But so you brought up a point here about a limit to total credit, but really since 2008, I mean, there's an enormous increase globally for total government debt and private sector debt and credit. We're over 300 trillion now in total global debt. That's total government debt and corporate debt. And it's grown, I think, by around 100 trillion since 2008, 2009. Do you think that there's a limit, or do you think that the people in power, they just figure that even though the debt can't be mathematically paid off, that they're just going to keep trying to roll over the debt until they come up with a new system?
Yeah, and I'll try not to go on a tangent on this, but if you look at Ben Bernanke's research, and he's supposedly the foremost expert on the Great Depression, and at some point he argued that after the crash, the Fed just needed to print, I think it was $6 billion. His analysis was, if the Fed would have printed $6 billion, recapitalized the banking system, we wouldn't have had to go through the depths of the Great Depression. Well, I just think the analysis is fundamentally flawed. The issue was not how much credit it took to recapitalize the banking system. The issue was, after the Roaring '20s, you had a maladjusted financial and economic structure that was a credit glutton. This structure took enormous amounts of credit to be sustained. If the Fed would have printed $6 billion, that would have lasted a few months, and then they would have had to print more. And all they would have done was to sustain the bubble, right? It was inevitable the bubble was going to burst. So what I would say today is, the problem here now, and you certainly see it in China and you see it in the US, especially after the last couple of years, these systems take enormous amounts of credit to be sustained. If you don't have that credit, then you're going to have asset price deflation that sets off big problems within the financial system and the economic system. But right now, there's this view that that credit's not even an issue. And I think at some point, and I mentioned this earlier, I think at some point, not only do you need a lot of credit, this credit is causing inflation at the consumer level. There's a political backlash. There's a backlash by the public, and central bankers are under enormous pressure. And at some point, even the bond markets protest. And at that point, it's going to be much, much more difficult to create the credit necessary to sustain these bubbles. So I think it's all leading to, this crisis of confidence in the markets and in policymaking. It's taken longer than I would have thought, but I still think it's inevitable.
And I think what has caused it is all the stagflation in the real economy. The supply chain problems is just killing the average person, middle class person, small business owner, or working class poor people who have to earn an income just to survive. I mean, all their bills are just going up, and most people cannot grow their incomes to offset the stagflation and the taxes.
Right, exactly. And supply chain issues certainly are a significant factor. I would argue that the past 25, we'll just say 25 years, it was an aberration for inflation dynamics. You had these powerful forces, the technology revolution, globalization, the rise of China and the emerging markets as industrial powers. The U.S., we could, just basically print money and import goods and services. You had low consumer inflation, generally low consumer inflation. So the Fed was able to focus on just the asset markets and disregard inflation. So policymaking shifted to basically just backstopping the securities markets. And that only reinforced inflation dynamics, because if you created liquidity in the system, it wouldn't go to consumer prices, commodity prices. It would gravitate to where it felt it was being backstopped by the central bankers. It would go into securities. Well, I think that was unique. I think it's over. So now I think inflation has fundamentally changed. I think the upward bias will be on consumer price inflation. And down the road, when we have the next round of QE, that QE is not going to just gravitate to bonds and stocks. It's going to gravitate to commodities, and it's just going to lead to higher inflation. So I just think the inflation, and what I'm saying, Jason, we've started a new cycle. The old cycle, 30-year cycle, it's over. Most people haven't recognized that it's over. There is a transition phase here, but we've started a new cycle where inflation is going to be a problem. Central bankers are going to be under pressure. And I think certainly hard assets outperform financial assets. We can't just keep, a lot of these financial assets, call them what they are. They're IOUs. They're electronic debits and credits, this huge global general ledger. Well, we can pretend that those electronic entries have value. We can pretend that we can create another 100 trillion and there's real value there. But at the end of the day, there's not value there. And at some point, there will be an adjustment. There'll be recognition that all the perceived wealth tied up in electronic journal entries is not something that people want to put their future into, right? It's just an unstable store of wealth, store of value. And again, it's part of this, crisis of confidence dynamic that I expect to unfold.
And I think long-term, we're still going to have a commodities bull market. The Fed, and you talked about what the Fed can do. They cannot print more natural gas. They cannot print more oil. They cannot print more pounds of copper that's going to be needed for electrification and electric vehicles and more countries modernizing their electrical grid. So all these supply side things with the global food and energy crisis, key industrial metals, there's been a lack of investment, problems on the supply side, rising costs throughout the entire commodities complex with this inflation and higher energy costs. These things are all going to lead to a commodities bull market that's going to continue. Yes, we've had big corrections here in the last 4 or 5 months, but I think that's just like a short-term bear market cycle within a longer-term bull market, because the Fed cannot solve. These governments are, in most of these countries, Doug, there's oil and natural gas drilling bans. So there's electricity shortages. I just saw a video last night. There's enormous factories in China that supply all of our technology companies here in the US and Europe. Those factories in China don't have electricity. They had to shut down. So there's not enough natural gas. There's not enough coal. And that's the case in not only China, but also in the European Union. There's going to be legitimate shortages in Germany for German manufacturers and also for hot water and electricity.
Absolutely. We could talk geopolitical. We can certainly talk climate. And Jason, in China right now, in Sichuan province, which is, you just mentioned, they're a major industrial hub. They supply a lot of components, technology components, solar, aluminum alloy, zinc. You can go down the list. Well, they have an interesting dynamic right now because there's a huge heat wave, and their electricity demand is skyrocketed because of air conditioning needs. So their electricity demand is up, let's say 15%. In the meantime, because of the drought, they rely on hydro power. Their output from the hydropower is down 10% because of the low water levels. So all of a sudden you have demand up double digits and supply down double digits, supply down, and you've got a heck of a problem, and you have to shut factories so people can survive in their apartments. And these are not temporary issues, right? These are not temporary issues.
Exactly.
They could certainly get worse every year.
Well, the costs for natural gas in both the European Union, the United Kingdom, and Asia are much, much higher than here in the United States. So natural gas prices here in the United States are up a lot, but they're up even higher in those other countries. So there's actually an enormous natural gas bull market, especially for companies like liquefied natural gas companies here in the United States that can get those contracts in Asia, the European Union, and the United Kingdom. They can book those contracts and make a very good long-term contract price exporting natural gas there.
Exactly. And Europe, obviously, they're desperate to have inventory for this winter. It's turning very serious in Europe with their energy crisis.
Oh, yeah. Just because commodity prices are down, well, not natural gas, but a lot of other commodity prices are down the last 4 or 5 months. I do not think the food and energy crisis is going away. I do not think the commodities bull market is over. I think things are far from done. I think we've just had a big correction here. The sentiment on Wall Street, though, money managers, retail investors, very, very negative for commodities. But I think this is a good buying opportunity over the next 6, 8, 12 months for smart, the long-term, low-cost producers in the commodity sector.
Yeah, at McIlvany Wealth Management, we love hard assets. Our MAP strategy, that's our long strategy, heavy on resources. So we see this as a real opportunity, this pullback, because again, we think this is the start of what will be a long cycle of hard asset outperformance of financial assets.
Especially if governments are going to ban oil and natural gas drilling, and the countries that can actually increase production, I mean, they're going to mint money because
Right.
demand for electricity, demand for natural gas, all the demand for fertilizer, these things are all going up. So, I mean, I called the natural gas bull market 2 years ago when it was at 2. So
Nice call.
but I want to get your opinion here. So if the Fed does keep increasing interest rates, and they're saying that they're going to in the September meeting, there's going to be a couple more quarter basis point hikes. What credit bubbles, in your opinion, will burst first?
The Fed has a real challenge. I think it was back during the May FOMC meeting where Powell referred to financial conditions 17 times during his press conference. So what the Fed's going to do here, or what they're saying they're going to do, is they're going to monitor financial conditions, and when they see financial conditions tighten, then they're more comfortable that inflation will decline and that they can at least ease back on their tightening policy. Well, 4 weeks ago, financial conditions were really tight. We were in de-risking, deleveraging. The junk bond market was basically shut down. The investment grade market issuance slowed dramatically. A lot of companies started layoffs because they were being denied access to new money, venture capital, private equity. Everybody was under stress. Well, we have a market rally. Financial conditions today, or not necessarily today, but over the past couple of weeks, very loose. Debt issuance is booming again. Even some junk issuance. All the risk premiums have declined. So this rally puts a lot of pressure on the Fed because inflationary pressures right now, they're going to be very stubborn. Henry Kaufman was interviewed in the Financial Times, and he said, the great Henry Kaufman from 70s Salomon Brothers fame, 70s and 80s, where he said the markets have to be shocked to try to get inflation under control. Well, as long as financial conditions are loose, I think inflation is going to surprise on the upside. So the Fed's challenge is going to be they're going to raise rates, and then I say they're going to raise rates until something breaks, and then all of a sudden you're going to have de-risking, deleveraging. The financial conditions are going to be extremely tight, and everyone's going to say they tighten too much. So the Fed, it's untenable for them right now what they're trying to do, to use financial conditions as their gauge to manage monetary policy, because the markets are going to zig and zag and cause them all kinds of grief. But at the end of the day, I don't think the system can stand higher rates like this, the treasury debt, the leverage in the system. So I think the Fed is going to be forced into raising rates until the markets buckle. And that's not a pleasant scenario. What bubbles? There's bubbles all over the place. And again, these are synchronized global bubbles. So the U.S. will fall through the same time Europe, the emerging markets, China, and it's all like one big speculative trade at this point, and I assume it falters the same time.
Well, one of the bigger ones, and this would hurt tax revenues across the board at all levels of government here in the United States, at the federal level, at the state and local government levels, because you have so many of these state and local governments are overly reliant on property taxes and other forms of real estate taxes to fund their treasuries. These state and local governments do not run budget surpluses. They do not keep a lot of cash on hand. Is if the Fed keeps raising interest rates and mortgage rates rise, if we have, Doug, similar to the housing bubble bust in 2007, 2008, 2009, if real estate prices do crash and stay low for a while, is that going to mean the Fed has to totally abandon any rate hikes and they have to go and immediately then start rescuing the state and local governments 6, 8, 10 months later after real estate prices crash, because these governments don't keep cash on hand for a rainy day, for problems? They're all, if you talk to a lot of these state and local governments, I mean, they're just assuming that real estate prices are not going to crash. They're assuming that people are going to be able to sell their homes at a higher price. People are going to be able to pay high property taxes that keep going up. Those assumptions would be false then if real estate prices do crash and stay low for a long period of time.
Absolutely. And the state and local governments are flush with cash right now, right? The receipts have been enormous. California is a great example. And it may take some time, but if you look at California real estate prices and really real estate prices across the country, the excesses have been even greater in many cases than during the mortgage finance bubble period, 2002 to 2007. You could see, the California real estate market being a huge issue, and the state of California finances could reverse course and have enormous deficits. So, yeah, I think it's coming. My own view is it might take a little longer for the state and local governments to feel these effects, because there's kind of a bit of a lag with tax receipts and things. But that's part of the unfolding scenario, I fear.
So I know you study Austrian School Economics because I've had you on in the past and we've discussed about Austrian School Economics. The cure for all this is deflation, allowing the currency and credit, the amount of currency and credit issued to fall. Prices then subsequently would fall afterwards. Can governments and central banks actually allow deflation for a long period of time without more bailouts, rules changes, QE, or other ways to debase or devalue their currencies?
Well, they certainly don't want to let it happen, right? The question is, will their extraordinary measures be able to hold the system together? We're to the point now where a big asset market collapse and credit collapse, that would be devastating for the global financial system and for global economy. So everything will be done by policymakers to try to avoid that scenario. We'll see if, to what extent that they can, at least hold some of the deflation in the asset markets in check. Not clear.
So before we move on from global macro issues to maybe some companies and some sectors, I want to get your thoughts on China. So you touched on China's housing bubble busting. Do you think that the People's Bank of China, which is their central bank, and the Chinese government, are they going to copy very similar bailout tactics to their state-owned enterprise banks, to what the Federal Reserve and the US government did in 2008 and 2009? Are they going to kind of basically try to repeat the same playbook there where they'll create enormous capital controls within their domestic economy so currency can't leak out? And they're going to make sure that the banks get some type of bailout, because even though real estate prices are falling, the banks won't look insolvent then. The money will be printed to save the banks.
Well, they have criticized Western central banks for QE. They've criticized them. I think they want to avoid that scenario. I think they look back and they still believe that their stimulus in 2009 was too significant, too aggressive, and that led to bubbles. But at the end of the day, I don't think they're going to have much choice. It's interesting, they've got these asset management companies, Huarong, Cinda, and Great Wall. These three, huge institutions that they set up some years ago to help in a crisis environment by buying up problem assets from the banks. Well, now these big institutions are big problems. So what do they do next? Clearly, I assume the Chinese banks will be nationalized. I assume the big developers will be nationalized. But at the end of the day, can they hold their currency together? Could there be a run on their currency? And I think it's going to be very difficult for them to keep a stable currency in the unfolding environment. Their real estate bubble, it's so far off the charts, and it's not like here where we have single family homes. There, it's apartments, and for the most part, poorly constructed apartments. And these prices are ridiculous compared to median incomes in different locations. And there's also, the estimates are anywhere from 50 to 100 million unoccupied units. So objectively here, this is an unmitigated disaster, not only for the Chinese household sector that has a huge part of their net worth locked up in their apartments, but also in their economy that's been so focused on construction, for their whole banking system, their financial system that is loaded to the gills in either mortgage or real estate related loans. So I'm not sure how they get out of this.
Well, they're not capitalism. They're not full capitalism, and not that any country is, but they're a lot less. I mean, they said that they didn't want to do bailouts, but I mean, they did that in 2008. They've been secretly doing bailouts. I mean, the Chinese central bank, they have enormous capital controls compared to a lot of other countries. So they've been doing enormous amounts of central planning, the infrastructure investments that they did, 50% of their GDP in 2009, that prevented China from collapsing back then, their enormous spending bill.
Yeah, and the situation in China right now, it's interesting because you're getting homeowners, apartment owners there that are protesting and boycotting paying their mortgages. These are people that, some up to 2 years ago put significant down payments down on apartments that now are not being constructed because the developers are basically going bust. They don't have money to finish construction. Country Garden, for example, the largest Chinese developer, it's been estimated that they need $50 billion to finish construction on projects that have been pre-sold. So all of a sudden, it's not so easy to control your crisis here if you've got households around China deciding not to pay their mortgages, deciding to protest. Also, confidence is faltering. The home sales have dropped dramatically. What does confidence do when prices drop dramatically? We've seen significant price declines for new home units as developers need to liquidate these units to get cash flow. But the official numbers on existing apartment sales, it's only a very modest price declines. I think as those price declines accelerate, you'll have a crisis of confidence, and the Chinese will back away from mortgages or back away from buying apartments, and this is going to be very difficult for Beijing to control. You can control a bank, you can recapitalize them, you can recapitalize a builder, but how do you get hundreds of millions of Chinese to be confident to continue to spend, to continue to buy apartments? I think that's going to be a real challenge, because I frankly think that the Chinese now, they're going to really start questioning Beijing. Before, it was the great meritocracy, astute management of the economy, the financial system, global affairs. Now I think a lot of Chinese look at their economy, look at their housing markets, look at the partnership without limits with Putin, and it's hard for me to believe that they're as confident in the future as they were just a couple of years ago.
Yeah, I think what they could do, and the U.S. did this after our housing bust for like 3, 4, 5 years. The U.S. did this, was the U.S. was offering younger adults like me enormous subsidies to try and go and buy a house with a discounted mortgage instead of paying rent. So we could see similar tricks to that with their banks, where there's some type of subsidy or some type of discounted mortgage, or maybe people don't have to make a payment on their mortgage for a while. But like you said, there are, I think, at least 1 million people who are not paying their mortgage right now. Now, they can't strategic default in China like they did in the United States, but there are bank runs too. So there's videos now of Chinese state-owned enterprise banks where people are not trusting the banks because people see that these banks have all these bad loans outstanding for real estate, and we're relying on high real estate prices, and then they want their money back, and then they can't go get their money. So China's dealing with a lot of serious issues now in their financial system because of falling real estate prices and
exactly,
and too much credit in their total system. They're all relying on high real estate prices. And then I think weren't they also talking about another infrastructure bill, another trillion or $2 trillion in infrastructure? But I mean, like, at this point, I don't think it's going to do a whole bunch.
Yeah, they have infrastructure projects. It's going to be, Japan did this for decades, right? The bridges to nowhere. But let's do a little bit more bubble theory here, just to kind of try to put this into perspective a little bit. The way bubbles work is, if you have a bubble and the bubble bursts and then policymakers come in to reflate it, you need to have a bigger bubble. You can only reflate out of the previous bubble if you inflate a bigger bubble. So think about the dot-com or the technology bubble from the late 90s. Well, the mortgage finance bubble was significantly bigger. So that was a successful reflation. I'll say successful. They reflated into a bigger bubble.
Well, Paul Krugman would call it a success.
Good for Paul. But the problem is, this bubble, we're 13 years into it. As I said before, it's gone to the heart of money and credit. This is the big bubble. When this one bursts, there's no other bigger bubble following it. So there'll be a lot of things that policymakers will try to do to sustain the bubble, but they don't have any source of credit bigger than central bank balance sheets, bigger than government, debt. So,
and there's no bigger asset market in China than the real estate market. That's by far the biggest.
By far. So to me, it's policy tinkering. There's no, and maybe I'll I have to correct myself again, as I have over the years, right? But what is the next big bubble to reflate when this one bursts? I don't see it.
Well, I see central banks keeping governments alive and maybe bailing out large corporations. The little guy, the small business owner, the average person listening to this podcast who's middle class, who doesn't work for a large corporation, doesn't own or run a large corporation, isn't a DC insider or an insider in Beijing, they're going to be the ones to suffer. They're not getting bailouts. They're not getting handouts. Meanwhile, their governments are picking and choosing winners and losers, and there's more stagflation in taxes. Unfortunately, that's what I see going forward.
Right. And there's going to be enormous pressure on the Fed to fight inflation. because again, I think these inflationary dynamics now, they're certainly not transitory. I think they're part of the new cycle. So there's going to be constant pressure. And even during crises, the Fed's going to have to think twice before they do anything too crazy, because they're going to have to fear the inflationary consequences of their QE operations. This is new. They haven't had to do this before, right? They didn't have to do it before. They will going forward. So this should put somewhat of reins on QE somewhat. So for my framework, the bubble's so big. QE, the last QE program by the Fed was $5 trillion. Well, the next QE program is going to be even bigger, but unfortunately, it's going to be an environment where there's already inflation. So they're not going to be able to do, a $7-8 trillion QE program without significant inflationary consequences, and I think a bond market revolt. But I don't like to get too far ahead on the analysis. I come in every day and do my best to follow developments and kind of adjust my view as I see things unfold.
But one thing that won't change, Doug, and I've lived outside of Washington, D.C. now for over 20 years, the politicians, both parties really, they want to spend more. So if there's an excuse to spend more, if the dollar is too strong, or if the economy is in a recession, that just gives D.C. an excuse, both parties normally, to want a spending increase. So unless government spending would drastically decrease, and I don't really see any signs of that, I mean, the Fed's going to be the buyer of last resort of U.S. Treasuries, because I don't really see a lot of foreign demand increasing for U.S. Treasuries right now.
Well, yeah, I'm expecting, a lot of foreign selling. And from, China will continue to sell. The emerging markets will continue to sell. It's not clear to me where the buyers of treasuries are. I think there's a lot of complacency right now because, 10-year treasury yields at 280, 290, they're so low. So I think there's complacency that they'll always be low. Well, I think the reason they're this low, is because of these dynamics I spoke to about China, of these global crisis dynamics that are unfolding. It reminds me a lot of how the treasury market acted in 2008, heading into the 08 crisis. So at the end of the day, though, I think that the treasury market, and I'm not saying over the coming months, I'm saying over the coming years, the treasury market's going to be a problem for the Fed, because I think the treasury market at some point is going to protest not only QE, it's going to protest government spending policies. So the disciplining process will unfold here.
The other problem, and the U.S. government took advantage of this, the Fed took advantage of this, I don't see a lot of these other foreign governments running enormous trade surpluses because their energy input costs, their commodities input costs for raw materials are so much higher. So a lot of these other countries are not running enormous trade surpluses. Therefore, then they're not recycling those trade surpluses into U.S. treasuries, buying U.S. treasuries for foreign exchange reserves. And even if they were running large trade surpluses, the governments, whether it's China or Japan, have said they're not going to be buying as many U.S. treasuries.
Exactly. And I appreciate that you mentioned this, because I think this is an important dynamic that doesn't get a lot of attention. I always just refer to the recycling mechanism during the previous cycle, the multi-decade cycle. We could run and did run enormous trade deficits. I think last trade surplus we had was in 1993, I believe. So we can run these enormous surpluses or deficits. The other countries that run surpluses then just recycle those dollar balances right back into the treasury market and into U.S. financial assets. Why have they done this? Well, for one, it's been a sure bet because they were confident that the Federal Reserve would ensure that these securities held their value. So they couldn't lose on this trade. Well, I think they can lose now. Not only can they lose on these holdings, they also can lose because of their currencies being weak. So they're going to have to liquidate these holdings of treasuries to support their own currencies. So again, that's part of this new cycle that's unfolding. And I don't think it's going to be kind to U.S. financial assets over time. And we'll see about the dollar. Right now, the dollar, I think it's strong because of speculative dynamics. With the bubble bursting in China and contagion impacting first the emerging markets, I refer to this periphery and core analytical framework, where risk off, risk aversion hits first at the periphery, out the fringe, the higher risk borrowers. And that can be companies, countries, regions. And the initial part of stress at the periphery can actually benefit the core because you can get a flight from the periphery to the core. I'll throw out the example of 2008 or 2007 when you had the subprime blow up in the summer of '07. Well, that led to declining treasury yields and increased prices of AAA mortgage-backed securities, kind of at the core of the mortgage finance bubble. So I think right now the dollar has benefited. U.S. Treasuries, fixed income, they've benefited from being part of this core in a world of faltering bubbles. But I think it's a temporary benefit, as it was temporary benefit back in '08.
I have one final question for you since we've been talking for about an hour. What industries do you think are in the most trouble right now with stagflation, higher input costs, margin compression, bad balance sheets with too much debt, especially if the Fed raises interest rates and their junk bond financing is higher, and collapsing sales?
Sure, and there's a list here, but I think the technology bubble has burst. And keep in mind, for recent years, it was free money. Any startup with any idea could get money, venture capital, private equity, bank finance, market finance. They could go out and buy as many servers as they wanted, whatever infrastructure they needed, and they did. Right, and it reminded me back in the late '90s. A lot of the technology bubble itself was technology startups buying technology product. It wasn't necessarily end users, the consumer. It was part of the bubble of all these uneconomic .com companies that were spending enormous amounts of money. And then when the money spigot was turned off, they just disappear. They collapse. They go out of business. Well, I think that dynamic is starting to unfold here in the U.S. It's just a heck of a lot larger than it was in the late '90s. So the technology bubbles burst. We're seeing some weakness in the semiconductors, et cetera. We've seen finance tighten in venture capital. So that's an unfolding, bursting bubble. Certainly, consumer discretionary, housing. There's a lot of sectors that are vulnerable in this unfolding dynamic of significantly tightened finance and negative wealth effects that we haven't had for a while on declining stock prices. So to me, it's basically systemic. There's a lot of sectors that are vulnerable, but this is going to unfold over quarters and years.
And sentiment right now, whether it's gold mining companies, oil companies, potash and fertilizer companies, despite seeing all the headlines of food and energy problems, I mean, the sentiment for the stocks is extremely bearish with commodity prices and commodity future prices, except for natural gas. Most commodity prices are down enormously in the last 4 or 5 months. So I think there's good opportunity there for a contrarian investor that's looking 18, 24, 36 months out for a nice, when the cycle does reverse, when people realize there are supply side problems, that there's not enough investment into the supply, that the cost to produce a lot of these different commodities is a lot higher. And the producers, either they're going to go bankrupt or they're going to have to raise their prices to maintain the levels of supply or to replace the supply they produce. So I think there's a lot of opportunity there in commodities for the contrarian investor that's not short-term focused over the next couple of months.
Yeah, I would agree, Jason. And over the past couple of 2-3 months, I think part of the dynamic here is when we had the unwind earlier in the year with technology stocks in particular, equities getting pummeled. There was a lot of speculative finance that gravitated towards the commodities, right? Not only were they outperforming, there's a nice store of value in this environment. Well, when equities rallied, all of a sudden, a lot of hedge funds, a lot of speculators were on the wrong side of a number of trades. Certainly the hedge funds were long commodities, long resource stocks, and I think they took it on the chin and they're impaired right now. A lot of funds have losses, so they had to cut back their commodity exposure just to mitigate losses. So I think there's some speculative dynamics that have played a key role in commodity weakness over recent weeks.
Well, there's also a lot of shorts on a lot of these commodities, whether it's the copper price, their silver. Some of these commodities had record high levels of short positions, net short positions on the commitment of traders. So that will eventually have to reverse, well, unless demand collapses for some of these things. But I don't see long-term copper demand totally collapsing, silver demand totally collapsing. Maybe in the short term, but long term, there's big supply problems for many different commodities.
Right. I tend to like the precious metals. I don't feel there's as much uncertainty related to the global economy in China, but I share your sentiments there. Long-term bullish on resources generally.
Oh, yeah. And the food and energy crisis, I mean, bad government policies. I don't see the food and energy crisis going away. I mean, we're still seeing news stories come out of fertilizer bans and bans on natural gas, oil and natural gas drilling. Pipelines and refiners are getting grilled in public by politicians. Same thing with oil companies with windfall profits taxes. I mean, as long as that occurs, you're not going to see a lot of investment on the supply side.
Right. I agree.
Well, Doug, I want to thank you so much for your time today. If my listeners want to check out the Credit Bubble Bulletin blog or take a look at the McIlvaney Tactical Short program, how do they do so?
Sure. Well, my blog to start with, you can go to creditbubbleblogspot.com. That's my website. You can go to mwm.com for our McIlvaney Wealth Management website, where we have a lot of information on tactical short. We have my articles on the McIlvaney Wealth Management website also. So you got two sources there. If you haven't had enough of me over this past hour, you can get more elsewhere.
Excellent. Well, I really enjoyed our discussion today. I always learned so much from you with your wealth of experience in the hedge fund. I think you worked with you worked with Bill Fleckenstein at his hedge fund for a while, right?
Yeah, I did most of my time with Gordy Ringon in San Francisco, worked a bit with Bill Fleckenstein and with East Shore Partners out in New York, and Prudent Bear Fund, 16 years, Prudent Bear Fund, Prudent Global Income Fund, when we had that for 12 years. And then McIlvaney Wealth Management, I guess, this year, wow, I think it's this year six. So anyway, I've been around, I have the gray hair to prove it, seen a few market cycles.
And the Credit Bubble Bulletin blog is one of the best sources for free global macro news. I mean, you track a lot of the news stories from pretty much all of these central banks. So if our listeners want to follow what the Bank of Japan is doing or emerging market central banks, the Credit Bubble Bulletin blog covers this basically every week.
I do my best. I'm up late Friday night trying to get the Credit Bubble Bulletin posted late Friday nights and trying to do my links. I do the best I can. It's a labor of love, and hopefully a few folks out there find some value in it.